What happens when one of the world's most desirable places to live becomes the hardest place to afford? California. Sun, surf, innovation, and a housing market that makes headlines for extremes. For years, the story was sky-high prices and frantic bidding wars. Today, the question is different. Will the market crack under pressure, or will it recover and recalibrate into something more sustainable? Over the next 20 minutes, I will guide you through the numbers, the trends, and the human stories behind them. We'll examine statewide forecasts, the pulse of recent months, the wildly different local markets across the state, and the risks that could turn a slow adjustment into a sharper break. By the end, you'll have a clear, evidence-based answer to the central question: will California's housing market crash, or will it recover? Start with the forecast. Statewide projections point not to a crash, but to modest, measured change. Existing single-family home sales are expected to rise to about 274,400 units in 2026, roughly a 2% gain from current projections. That's not a boom. It is a cautious return of activity after a period of slowed transactions. At the same time, California is likely to see new price records, but at a far slower pace than the double-digit surges some remember. The projected statewide median home price in 2026 is roughly $905,000, an increase of about 3.6% from the 2025 projection. In short, modest growth in sales, record prices, and stability rather than spectacle. To understand why the model points to recovery and not collapse, we need to examine the recent market pulse. In August of 2025, the market showed a small but meaningful rebound. About 264,240 existing single-family homes were sold that month, a slight uptick from July and roughly level with the previous August. The statewide median price hovered near $899,140, reversing a short run of year-over-year dips. A key factor: mortgage rates. When rates eased, even briefly, buyers reappeared. Forecasts anticipate the average 30-year fixed mortgage rate falling toward 6% in 2026, down from about 6.6% in 2025. That easing alone improves purchasing power and nudges some marginal buyers back into the market. But a rebound in sales does not hand the market over to buyers. In August, the sales-to-list price ratio averaged approximately 98.3%. Many homes still sold very near asking price. Unsold inventory moved to about 3.9 months, and the typical time on market lengthened to roughly 31 days. Those shifts give buyers a bit more breathing room, but not unlimited leverage. One of the most important truths about California is that it is not a single housing market. It is many markets. Regional and county data underline this reality. In 2025, only two major regions posted year-over-year sales gains: the far north, up about 2.9%, and the Central Coast, up about 1.6%. Other regions cooled. The San Francisco Bay Area, for example, saw sales fall by roughly 4.1%. Price movement was similarly mixed. The Central Coast led with price growth near 6.3%. In other places, prices slipped. Parts of the far north and sections of the Central Valley saw small price declines. The statewide median masks stark local differences. Look at counties and the contrast becomes dramatic. Some rural counties posted astonishing sales spikes. Mariposa recorded an 81.8% year-over-year increase in sales. Lassen rose by 46.7%. Kings County jumped about 36.1%. At the opposite extreme, some counties experienced sharp declines. Yuba County saw sales fall by roughly 35.3%. Calaveras fell about 31.3%. Tehama dropped near 24%. Price swings followed similar patterns. Coastal and high-demand tourist counties saw outsized gains. Santa Barbara, for instance, registered price growth around 32.6%. Meanwhile, rural northern counties such as Del Norte and Mendocino posted price declines of roughly 21.7% and 17.3%, respectively. The takeaway is simple and vital. Local context matters more than the statewide headline. A recovery in one county can coexist with distress in another. Inventory is the lever that shapes many of the outcomes we just described. Forecasts anticipate active listings to rise by roughly 10%, a move that would nudge supply closer to pre-pandemic levels. More listings mean more choices for buyers and, in many cases, pressure on sellers to price and present realistically. Affordability is improving only slightly. The Housing Affordability Index is projected to climb from about 16% in 2024 to 17% in 2025, and then to roughly 18% in 2026. That is an improvement, but modest and still historically low. For most households, owning a median-priced California home remains a stretch. Beneath these housing numbers are broader economic currents. U.S. GDP growth is expected to slow to about 1.3% in 2025 and to near 1% in 2026. California's own non-farm job growth is projected to be modest. The state's unemployment rate is forecast near 5.8% in 2026, with inflation averaging around 3%. These are not boom-time conditions. They are the backdrop of a cautious market that will move slowly, not explode. Despite the overall picture of stabilization, risk is unevenly distributed. Independent risk assessments identify clusters of vulnerability. Roughly 14 California counties were highlighted among the highest risk markets nationally, based not only on price levels but on a combination of affordability challenges, negative equity, foreclosure risk, and elevated unemployment. The human scale of that risk is stark in certain places. In wealthier coastal counties, housing costs can far exceed local earnings. In one county, typical home expenses were estimated at nearly 119.7% of a typical resident's annual wages. In San Luis Obispo, typical housing costs approached 99.3% of average wages. Those numbers mean households are allocating nearly every dollar they earn to housing in those communities, leaving little left for other essentials and making them fragile in the face of a job loss or rise in interest rates. Other counties face severe employment challenges that compound housing stress. Imperial County had unemployment near 19%, and counties such as Tulare and Merced reported unemployment rates above 10%. High unemployment, low wages, and steep housing costs create conditions in which foreclosure and distress sales become more likely. There are several headwinds that could turn a modest adjustment into a more acute downturn in localized pockets. First, the home insurance crisis. Rising premiums and insurers retreating from fire-prone areas make home ownership more expensive and transactions more complicated, particularly in regions exposed to wildfires. For some potential sellers and buyers, the absence of affordable insurance can effectively take a property off the market. Second, broader economic volatility. Trade tensions, stock market swings, and global shocks can dent consumer confidence and slow hiring. Because many California households derive wealth from equities and retirement accounts, substantial market declines can quickly translate into reduced willingness to buy. Third, market psychology. Sections of the market that saw outsized gains in recent years could be vulnerable to corrections if sentiment shifts. A correction in a high-valuation segment does not necessarily translate into a statewide crash, but it can create sharp local dislocations and financial hardship for households with thin equity cushions. Taken together, these wildcards mean that while the statewide forecast anticipates recovery, that recovery will be uneven and conditional. Some places will strengthen, others will experience distress. So, what does this mean for everyday people making decisions today? For prospective buyers, obtain a mortgage pre-approval. Focus intently on local market data. and set a realistic price band for where you can afford to buy. If mortgage rates fall as anticipated, your purchasing power will improve, but affordability will still be tight in many communities. Be prepared to move decisively when you find a property that fits your budget and your needs. For sellers, price with care. The market rewards accurate pricing, good presentation, and targeted marketing. In a market where inventory is rising, patience beats panic. Rapid price cuts can erode returns. Measured, strategic pricing and staging are more likely to attract qualified buyers. For policymakers and community leaders, solutions require local focus. Increasing housing supply where jobs are growing, stabilizing insurance markets in high-risk regions, and directing job creation and training to vulnerable counties are essential steps. Statewide programs that ignore local realities will be less effective than targeted interventions that reflect county-level conditions. Here are the headline conclusions, summed up plainly. First, a catastrophic statewide crash is unlikely based on current indicators. The forecast points to modest growth in sales and record median prices in 2026, but at a much slower pace than prior booms. Second, recovery will be uneven. Some counties and regions will see gains and improved affordability, while others continue to face sharp declines or elevated risk. Third, affordability will improve only slightly as mortgage rates ease, and affordability will remain a systemic challenge for most households. Fourth, wildcards, the home insurance crisis, employment shocks, and financial market volatility could create severe, localized dislocations even as the statewide market stabilizes. The future of California housing is not a single storyline. It is a mosaic of communities, coastal cities and inland valleys, booming tech hubs and rural counties with struggling job markets. The data point toward recovery, yes, but it is a recovery written in many different voices.